invitation. Got it. So yeah, thanks a lot for the invitation to present work in the context of the digital futures research community. I have been looking very much forward to presenting work in this interdisciplinary context or setting that you have. The paper that I'm presenting today is titled Machinic or Machine Interaction, a Sociological Approach. It's ongoing work that I'm doing with a colleague of mine, Nicolas Skar-Gislinge. Nicolas is a physicist by training. I'm a sociologist, and the fact that I'm the one presenting our work today would also suggest that I'm presenting more, or what I'm presenting has a more sociological leaning. Nicolas would probably have presented it slightly differently. Now, the key problem we are interested in addressing is what is machine interaction and how can we understand it sociologically. Before I really get started, I should perhaps say that we understand machines in a fairly broad manner. So machines can refer to robots in various guises. It can also refer to algorithms or assemblages of algorithmic systems. So I'm going to be discussing in particular automated trading within the financial markets. And there you could say that algorithms that are submitting orders to the markets, whether it could be, say, in order to buy a stock or to sell a stock, these algorithms would usually be kind of conglomerations, assemblages of huge amounts or wide arrays of individual algorithms. So we are conceiving of these kinds of systems as machines broadly. And the thing that I'm interested in addressing is the fact that in many domains in contemporary society, machine interaction is the kind of action and interaction that is taking place. So there's an increasing number of spheres in society where humans are sort of bracketed from the action, and the action is taking place or being conducted by machines, and it's actually machines that are interacting in these particular spaces. So I'll give you a couple of examples to get the discussion going. One could be online advert auctions. So when I'm opening my computer in the morning and searching online, the ads that I'm presented with online would often be an outcome of a real-time online advert auction where different algorithms are bidding on getting access to posting their ads on my computer screen. So these are processes that are taking place at the level or below 100 milliseconds. So it's purely algorithmic. It's a pure interaction between fully automated algorithms that is taking place and deciding which ads are eventually popping up on my computer screen. So that's one example of a field constituted by machine interaction. Another one, and that's perhaps looking slightly more into the future, it could be automated vehicles. You could conceive of traffic situations in which automated vehicles are interacting with other automated vehicles. Or even more scary, perhaps you could conceive of automated warfare systems where automated drone systems are interacting with enemy drone systems that are also fully automated. So these are examples of domains in society where we can perhaps identify action taking place by machines and the central interaction taking place between or among these kinds of machines. So these are sites where this kind of machine or machinic interaction is very important. And today I'm going to discuss one example of this kind of machine interaction, namely the one that is taking place within the financial markets in the domain of automated trading. So I'll try to illustrate what this kind of machine interaction is about, but also how we can then possibly understand it sociologically. If we're looking at the financial markets, then the engine room, if you like, of financial markets. So the place in which orders to buy assets or sell assets, the engine room where these orders are being matched with one another. That used to consist of so-called trading floors. You have an image here human traders would be packed together, standing physically next to one another, yelling, screaming, pushing, jumping, making all sorts of hand signals to get their orders to buy or sell securities across. I'm sure you're all familiar with these kinds of images. What is interesting is that over the past decades, this form of trading has almost become obsolete. So during the 1990s, these trading floors started to be emptied. And in the 1990s, the action would then move more or less to screen-based trading, so-called electronic trading, screen trading, or click trading. And here you would have human traders still active, but each trader would then be confronted with a stack of screens. The trader would closely monitor price movements on the screen, perhaps also monitor news, etc. And then once an opportunity to trade would pop up, then the trader would execute a trade by essentially clicking their mouse. So this form of trading really took off in the 1990s, but around the early 2000s, it was also then slowly transformed or morphed into a new form of trading, namely automated trading. So as I said, this really took off in the early 2000s, and today the vast majority of orders that are being submitted to the financial markets are being submitted by fully automated algorithms. So this is an image of an actual trading firm in Chicago, and in general you could say that the kind of image that we're dealing with, if we want to understand financial markets today, would look something like this. We have fully automated computer systems that are interacting with other fully automated computer systems. In some markets, more than 99% of the orders that are sent to the market are actually sent by fully automated algorithms. So if I were, for instance, to buy some Apple shares, and I would send a message to my bank to get that order executed, what would happen is that most likely the bank would actually internalize the order. It would sell me the shares based on the pile of orders or pile of shares it already had itself. But in the case that the order would eventually be sent to some stock exchange, then that would take place via an algorithm that the bank would deploy. So this is just to say that if we're looking at financial markets, we're really dealing with a societal domain in which the main action is fully automated. It's computer algorithms that are interacting with other computer algorithms. Obviously, these algorithms are developed by human beings, and we can distinguish between different generations of algorithmic systems that are active in the financial markets. So back in the days, or back in the early 2000s, the algorithmic systems would be human-defined end-to-end, meaning that there would be teams of traders, human traders, who would conceive of a trading idea, and then it would be implemented into software and then eventually executed in the market. Today, an increasing number of firms are deploying machine learning algorithms where the idea is that the system itself would conceive of some trading ideas that would then be implemented in the market. But regardless of which kind of algorithmic approach firms are using, the fact still remains that the main action and interaction in the financial markets would take place among these fully automated algorithms. One of the reasons why this kind of interaction dynamic is then interesting to study from a sociological point of view is that often, or at least sometimes, these kinds of algorithms are interacting in ways that are not anticipated. So I've been doing interviews with firms deploying these kinds of algorithms for quite a while now, and many other sociologists have been doing that. And it's quite common that the people who are developing these algorithms would say that, well, our algorithms are designed to do this or that in the market, but once the algorithms are actually interacting with other algorithms, it might be doing something that was not anticipated, that was not pre-programmed or not foreseen. One illustration of these kinds of unanticipated events that emerge out of interactions between algorithms is the so-called flash crash that took place in May 2010 in the US markets, But actually, yesterday in Denmark, we had a similar flash crash. So this is just to say that these kinds of events are not that infrequent, actually. They do occur more or less frequently. But the flash crash from May 6, 2010 remains the most famous event and also the most dramatic one. So what happened, and you can sort of see that on this slide, we have the prices being registered by the red curve. You can see that at the beginning of the trading day, prices had a slight dip that was due, according to most accounts, to the fact that this was 2010 and we had the Greek debt crisis after the financial crisis, and that also affected the US markets. But really, what is interesting is then what is happening in the afternoon in the US markets. If you're looking at points 2, 3, 4, and 5, suddenly there was a very dramatic drop in the prices in the US. Then trading was suspended, and then after that, prices sort of recovered almost to the level of prior to the flash crash. Now, there are different accounts, different types of explanations of what actually happened there. The US regulators, after the event, they joined forces to really try to dig into the data and try to come up with an explanation. Most explanations remain contested, but the first major explanation they offered, the US regulators, was that it was a market participant in the US that wanted to really sell a lot of contracts. So they put in a number of sell orders in the market, and these sell orders were quickly absorbed by high-speed algorithms, but these algorithms didn't want to keep the orders or the contracts that they bought, so they also wanted to sell them again, and this dynamic really drove down prices, so that in the manner of only a couple of minutes, values equaling around $1 trillion would evaporate from the markets. So that was the first general account offered by the US regulators. Some years later, they offered an alternative account, namely that there was a British trader sitting in his parents' home on the outskirts of London, who apparently manipulated the markets by selling putting in some fake orders to the market, and that was also partly to blame for the flash crash. As I said, any of these explanations have been contested, and it remains unclear what actually happened on that day. But I mean, there's nonetheless general consensus, as I said earlier, that really what happened was that it was the interaction dynamic between these algorithms that triggered the dramatic drop in the prices. So this is one example of what might happen once machines start interact with one another. So how then to approach these kinds of phenomena sociologically? I think that if we're looking at sociology and looking at how sociology has traditionally understood machines, then it's possible to single out two major approaches. One is what I call the human machine analytic, and that one is what I refer to as the infrastructural analytic. And each of these are self-explanatory, more or less, in terms of the titles that they have here. So the human machine analytic would encompass studies that focus on the various ways in which humans and machines are interacting, including the ways in which humans might be affected by the ways that they are interacting with machines. So one example from the domain of the financial markets would be the work of the Chicago-based sociologist Cetina. She did work on these kinds of traders, foreign exchange traders working in electronic markets back in the 1990s. And what Cetina found was that for these traders, the main kind of partners, if you like, that they were interested in engaging did not consist of other human beings. Rather, for these traders, their main interaction partner was constituted by the computer screens, the market on the computer screen. So according to Knosetina, based on her empirical work, these traders were actually obsessively engaged with their interaction with the computer screens, the market on screen. So Knosetina coins the notion of post-sociality to refer to this, reflect this. So sociality would be the notion that sociologists would usually employ to understand interhuman behavior, so interactions between humans. Post-social relationships then refer to interactions between humans and some kind of machine. So this is one example of the human-machine analytic, if you like. Another example, and that's based on work that I've done myself, would relate to the work or to the field of automated trading. We did some interviews some years back with people who are developing these types of algorithmic systems. And one of the persons we interviewed, a trader in Chicago, he told us that he would be so engaged with his algorithmic systems that he would only sleep 4 hours a day or per night. But every night in that 4-hour time span, he would wake up every 45 minutes to check whether his algorithms were actually functioning properly. So this is another example of this human-machine analytic and understanding of how humans and machines are interacting with one another. So as I said, this would be one common approach within sociology in terms of getting a sense of machines and their effects and implications on society. Another approach is then what I refer to under the heading of the infrastructural analytic. And basically this kind of approach would identify either machines as constituting particular infrastructures, or they would emphasize the ways in which particular machine interactions would depend on particular infrastructural underpinnings. So again, within the work of, or the domain of automated trading, there's very interesting work by Donald McKinsey and Juan Pablo Baruguera that demonstrates that contemporary financial markets and contemporary automated trading relies upon very particular types of infrastructures. It could be legal infrastructures, it could be political infrastructures, but mostly, at least according to Donald McKinsey, it would be material technological infrastructures, including very particular types of high-speed data transmission systems. It could be infrastructure such as fiber optic cables, it could be microwave transmission, laser transmission, all sorts of systems that make possible the types of interaction, high-speed interactions among the machines in contemporary financial markets. So the point that I want to make is that both the human and machine analytic and the infrastructural analytic are interesting ways that sociologists have proposed in terms of understanding machines. But neither of these approaches really gets at what I'm interested in here, namely the actual inter-machine interactions in markets. So the infrastructural analytic can say something about the infrastructures underpinning the actual interaction, but it doesn't really say anything about the actual interaction taking place. So this is precisely what I'm interested in. How can we develop then a kind of sociological program that addresses this particular type of inter-machine interaction? And I think that to that end, if that's what we want to do, then two challenges immediately pop up. The first challenge is theoretical. The second challenge is methodological. If we look at the theoretical challenge first, then this challenge is about how to theorize inter-machine interaction in a way that does not resort to a kind of humanistic vocabulary. So it's very tempting to understand the interaction among machines, very similar to how sociologists have previously conceived of interactions among humans. And there's already work being done in that direction by, for instance, Donald McKinsey, but also Knosetina. I can come back to that in the Q&A if you like. But I think the challenge here is really to avoid this kind of humanistic vocabulary if we want to understand inter-machine interactions. So we need some kind of new foundation that is post-humanist in terms of getting a sense of how machines are actually interacting with one another. And what I'm proposing then is that perhaps one way forward here would be to focus on the ways in which machines are able to observe and respond to their observations. So in a very abstract sense, you can say that this is something that many machines, at least the machines that are sociologically interesting, are capable of. In the financial markets, an algorithm would be able to observe, that's what it's actually designed to observe how markets are moving, how prices are moving, and it can respond to the observations that it's making about market movements. So observation and response dynamics, or observation and response patterns, is something that would be relevant to study from the point of view of this kind of inter-machine sociology. It's possible, I think, to then, if we're taking that path, then to single out three emphases for such an inter-machine sociology. The first step would be to observe which kinds of machines are active in the setting that we are examining. So obviously there's a strong difference between algorithms that are bidding for placing an online ad, and algorithms that are placing orders in the financial markets. So a first step for an inter-machine sociology would be to really identify the types of machines that are active in our particular setting. The next step would be to identify how each of the machines that are active in a particular setting is observing the other machines and responding to these observations. So for instance, going back again to the financial markets, machines are pursuing very different strategies. To give one crude example, some machines are pursuing very short-term strategies, or others are pursuing very long-term strategies. That means a lot to the ways in which they are observing and responding to market data, for instance. So the next step would be to really figure out the differences in the ways in which these machines are observing and responding to their observations. And a part of that is to also understand how these observation and response patterns would be conditioned by the particular infrastructures that are characterizing the particular settings. So again, in the financial markets, you can trade on different trading venues. That there are official stock exchanges, for instance, but there are also so-called dark pools, which offer different infrastructures for how to trade with others. And depending on your trading venue, the kinds of observation and response patterns that are being afforded by the infrastructure would really differ. Then, as the final step in this kind of inter-machine sociology, and that's obviously the most interesting aspect, the task would be to examine what are the actual effects once these machines start interacting with one another. But this is then also precisely where the second challenge emerges, namely the methodological challenge. So here the challenge is really how can we study machines that are indeed interacting with other machines? The challenge here is that conventional sociological approaches, at least when it concerns financial markets, would tend to rely on qualitative data. So this includes my own work in the past. I've done, as I said earlier, a lot of interviews with people working in trading firms that are deploying these kinds of algorithmic systems. And of course, it's possible to do interviews with the people who are developing these algorithmic systems. But as I said earlier, often informants would say that, well, I designed my algorithm to do this or that, but it actually ended up doing something else because it started to interact with others. So what I want to get at here is that relying on qualitative data that sociologists have conventionally done when studying financial markets is not really a super source when it comes to understanding actual interaction effects. It could simply be that the people who are developing these algorithms don't have a super nice clue about how their algorithms are actually interacting. They could also measure it in wrong ways. So what we are proposing is then to go a completely different route, namely via using agent-based modeling. And of course, you can say that by using agent-based modeling or using any kind of simulation approach, it's not really understanding the actual interaction, but this interaction cannot be directly observed. So agent-based modeling or simulation can be a way of at least approximating the actual interactions that are taking place in relevant domains. So specifically, what we have been doing is to propose a kind of alternative to the existing simulation frameworks that are very popular. So there are lots of physicists working on financial markets, deploying agent-based modeling to get a sense of how markets are operating. So that's an entire field of so-called econophysics. And often these models, and that's my concern at least, they would be based on fairly simple conceptions of how markets are designed and operate. So only few types of agents, perhaps, or only few agents numerically are interacting under very restrictive conditions in many of these models. So what we have tried to do instead is to build a simulation model that is slightly more realistic. And we have tried to do that by combining our simulation with substantive sociological and anthropological work. So we have done a lot of interviews, almost 200 interviews with trading firms and others who are part of the ecology of automated trading. And we have then tried to extract insights from these interviews and import it into our agent-based model to make it as realistic as possible. So what we have now is a model, it's a multi-agent model, counting thousands of agents pursuing different classes of overall strategies, acting, or they're able to buy and sell different types of stocks. And they also have different latencies, they have different ways of or different temporal horizons in terms of how fast they can process data from markets. Again, a feature that is very important in terms of how actual markets are operating. And basically, via this work, we have been able to reproduce 8 so-called stylized facts of financial markets, so statistical properties of actual markets. And that's a vast improvement over existing models that would usually only reproduce 2 or 3 stylized facts. So the fact that we have added more complexity to our model has also increased its realism. And what we're doing then, and I'm just offering this as one example of the kind of analysis that is possible to do on the basis of this type of work. What we're currently working at is an analysis of financial cascades. So a cascade, as you know, would be a process or a sequence where one thing unleashes another event, and then you have an entire process unfolding on that basis. So the flash crash I talked about earlier would be one such event. Something triggers the event, and then you have a cascade of actions and interactions after that. And what we're looking at specifically in this work is how orders that are sent by individual algorithms into the market that might be rational and prudent from the point of view of an individual trading firm, how they might produce a cascade effect that is unwanted on a global level or at a market level, if you like. So we are looking at so-called stop-loss orders and take-profit orders. A stop-loss order it's a very common type of order that most algorithmic systems would have in place. It's an order that activates if prices are suddenly dropping dramatically. So let's say that I have programmed my algorithm to say that, well, if prices might be moving now around 80 dollars. If prices are suddenly dropping to 75, then I want to sell my position. And so it's the stop loss order would automatically sell my position if the price reaches a certain threshold. The reverse kind of process would be the take profit order. If prices are moving above a certain threshold, then suddenly I might be interested in taking home a profit and then selling whatever I had accumulated before that. And as I said, what is sociologically interesting about these types of orders is that, well, they are actually being, I mean, these are actual types of orders. Actual trading firms are using these types of orders. And from the point of view of an individual firm, they are completely rational to have. It's very prudent to have a stop loss order from the point of view of an individual firm, so that you don't lose a lot of money in an instant. You take a cut, if you like, in the kind of losses that you might accumulate. So from the point of view of an individual trading firm, they can be entirely rational. But from a market perspective, the issue is that each stop loss order can trigger a new stop loss order from another firm. So let's say that we have one firm, firm A, whose stop loss order is being triggered at the price 80. Price is going down to 80, then that firm's stop loss order is being activated. That means that firm A wants to sell its position, all the stocks it has accumulated. This obviously pushes down the price even further. Now it might go down to 75, and 75 might be the threshold of firm B, where that firm's stop loss order is being activated. And then suddenly you can have a cascade effect that is really driving prices down dramatically. And just to emphasize that this is not purely speculative, I've included here a quote from the official investigation of the flash crash back in 2010 by the US regulators. And indeed, they write that the Chicago Mercantile Exchange in the US paused trading because of fear that these stop loss orders would really, make markets crash completely. So in the work that we're doing, as I said, we're trying to simulate a particular market. This is just an illustration of how prices are moving in one of our simulations. We have 260 trading days here, and prices in this simulation are moving from a range around 96 to 108. And what we are then doing is that we are zooming in on particular events in the markets. So if you look at the top table here, what we can do in the simulation is that we can tag to each order being sent, whether it is a stop loss order that is being activated, whether it's a take profit order or any other type of order that is being activated. And what we're then looking into now would be a kind of forensic analysis of these events, for instance, that you have in the middle here, where you can see a number of identically colored orders following one another. So the green ones would be stop loss orders. You see here in the middle, one stop loss order that seems to trigger another one, that seems to trigger a third one, and so forth. And the same with take profit orders. So essentially, this is the kind of forensic work that we are currently doing based on the simulation work. We're trying to establish the extent to which it's possible to understand the dynamics of these cascade effects, including whether, say, a particular large order, or if the first stop loss order has a particular size, then it might be more likely to trigger new stop loss orders. These are some of the things that we are looking into. I'd hope to be able to convey some of the final findings for this, but this is still ongoing work. So if any of you are interested in these types of analysis, then drop me an email, and I'll come back to you in a month or two. So let me try to wrap up then. What I've tried to argue is that machine interaction is important. There's still more spheres in society where humans are being bracketed, and it's the main action and interaction is entirely machine based. So this, from a sociological point of view, points to a new sphere that sociology needs to really take seriously. But sociology also needs new conceptual tools to understand these kinds of inter-machine dynamics. We cannot really rely on a too human-anchored conceptual vocabulary here. I've argued also that simulation might be a suitable approach for studying these kinds of machine interaction, because we're dealing with forms of interaction that are not that cannot be observed directly. So simulating them might be one way forward in terms of getting a good sociological understanding of what is actually taking place here. And then more specifically, I've suggested that simulation might indeed be helpful if we want to understand when and why various types of cascades trigger. So I'll leave it with that and look forward to the discussion. Thank you.